Here's a question that should make you stop scrolling. What happens when the smartest, most well-funded, most influential people in global finance cannot agree on the future of a single asset? Not a startup, not a niche commodity, not some obscure derivative. Bitcoin, the most talked about asset of the last decade. One billionaire says it is still absurdly cheap at current prices. Another is openly predicting a path toward $1 million per coin. And a legendary trader, someone who has called major market moves for decades, is warning that a brutal correction could still be coming before any of the big numbers arrive. Meanwhile, Wall Street is quietly repositioning in ways that most retail investors haven't even noticed yet. So who's right? Because somebody is about to look like an absolute genius, and somebody is about to be spectacularly, publicly wrong. And the gap between those two outcomes could define your financial future for the next 10 years. Today, here on the Wealth Continuum, we are going inside the minds of the biggest names in finance: Michael Saylor, Cathie Wood, Tom Lee, Peter Brandt, and several other market-moving voices, to unpack what they actually believe Bitcoin's future looks like. And more importantly, we are going to look at what their actions reveal that their words deliberately don't. Because there is one thing happening behind the scenes right now, one force that is shaping Bitcoin's trajectory more than any tweet, any chart pattern, any headline, and almost nobody in the financial media is giving it the attention it deserves. Stay with me, because by the end of this video, you will not see this market the same way again. Everything discussed on the Wealth Continuum is for educational and informational purposes only. Nothing here constitutes financial advice, investment advice, or a recommendation to buy or sell any asset. All figures referenced reflect publicly available data as of June 25th, 2026. Always conduct your own research and consult a licensed financial professional before making any investment decision. And before we dive in, hit that subscribe button right now if you want to be part of a community that is actually thinking seriously about building wealth in the 21st century. The Wealth Continuum exists for people who want more than surface-level financial content. Let's go. Let's start with the honest truth about where we are today. Because I think a lot of people are feeling something they're embarrassed to admit out loud. Confused. Bitcoin isn't behaving the way the consensus said it would. A year ago, the narrative felt almost airtight. Spot ETFs arrive, institutions flood in, supply gets squeezed by the halving cycle, and Bitcoin goes on a parabolic run that silences every skeptic on Earth. Simple, clean, inevitable. Except markets have never once cared about our narratives. Instead, Bitcoin has spent much of 2026 wrestling with two forces pulling in opposite directions. On one side, institutional adoption is continuing to grow in ways that would have seemed impossible just 3 or 4 years ago. On the other side, macroeconomic uncertainty refuses to leave the room. Right now, as of this morning on June 25th, 2026, Bitcoin is sitting around $61,000, down from around $63,000 just days ago. The fear and greed index has collapsed to 12. 12. That is deep in extreme fear territory. And the broader market isn't helping. The S&P 500 closed yesterday at 7,358, and the Nasdaq is sitting at 25,476. Both extending a 3-session losing streak heading into today's PCE inflation data release. Here's a question I genuinely want you to think about and answer in the comments. When you see those fear numbers, when the index hits 12, do you feel panic or do you feel opportunity? Because your answer to that question says everything about where you are on your wealth journey. Because the fear isn't random noise. There's a real war being fought in the financial system right now. Interest rates remain elevated, global liquidity remains unpredictable, and the one question that every serious investor is circling comes back to the Federal Reserve. Will they eventually flood the system with money again, or will tighter conditions persist longer than anyone expected? Bitcoin sits directly in the middle of that battle. And that is precisely why the opinions of major investors matter more right now than at almost any point in recent memory. Because what we're witnessing isn't merely a disagreement about Bitcoin's price, it is a disagreement about the future of money itself. Stay with me, because the next chapter is where things get genuinely fascinating, and where most financial content completely misses the point. Let's begin with the most famous Bitcoin bull alive. Michael Saylor. Nobody, and I mean nobody, has tied their personal reputation, their company's balance sheet, and their entire public identity to a single asset more aggressively than this man. Not hedge funds, not ETFs, not sovereign wealth funds, not governments, nobody. Strategy, the company he leads, has been accumulating Bitcoin with a ferocity that makes most institutional investors look timid. And for years, critics have predicted disaster. They have called it reckless, irresponsible. A career-ending bet on a speculative asset. And for years, Saylor has responded by buying more. His thesis hasn't fundamentally changed, and I think that consistency is underrated. Here it is in simple terms. Bitcoin is digital property. It is the hardest, scarcest, most portable store of value that humanity has ever created. It exists in a world where every major government has demonstrated a willingness, sometimes an eagerness, to expand the money supply without limit. Now here is the part that most commentary misses. Saylor isn't comparing Bitcoin to gold as if it's simply a shinier version of a yellow metal. He's comparing Bitcoin to everything: real estate, bonds, corporate treasury reserves, national reserves, cash sitting in checking accounts, losing purchasing power every single year. In his worldview, Bitcoin isn't competing for a slice of the global financial pie. It is in the process of becoming the pie itself, the foundational layer of a new global monetary system. That's why he continues talking about million-dollar Bitcoin scenarios without blinking. And I know, sitting here in 2026, with Bitcoin at $61,000, that sounds like a number from a science fiction novel. But here's the critical insight. Saylor doesn't need Bitcoin to reach $1 million next year. He doesn't even need it next decade. His entire strategy works. His entire thesis holds if Bitcoin simply continues absorbing value from less efficient stores of wealth over the next 2 to 3 decades. And that is what makes him genuinely dangerous to bet against. He isn't trading Bitcoin. He is accumulating it the way a nation accumulates territory. Comment below. Do you think Saylor's conviction is visionary, or is it the most dangerous form of overconfidence you've ever seen in finance? I genuinely want to know where you stand. Then there's Cathie Wood. And if Saylor's conviction is intense, Wood's forecasts are the ones that make otherwise serious financial professionals do a double take. While most analysts are obsessing over short-term charts, support levels, resistance zones, moving averages, Wood is operating on a completely different time horizon. She studies adoption curves, the S-curves that define how transformative technologies move from fringe to mainstream. She watched this happen with smartphones, with the internet, with cloud computing, with artificial intelligence, and her argument is that Bitcoin is following the same curve, just with far more capital at stake than any of those previous technologies. Here's the core of her thesis, and it is worth sitting with for a moment. Think about who does not own meaningful Bitcoin exposure right now. Most pension funds don't. Most sovereign wealth funds, which collectively manage tens of trillions of dollars, don't. Most corporations have not adopted it as a treasury strategy. Most governments have not begun treating it as a reserve asset. In other words, and this is the number that should make you pause, we may still be in the very early innings of institutional adoption. Even after everything that has happened, even after the ETF approvals, even after all the headlines, if Bitcoin is adopted by even a relatively small percentage of these institutional pools, the demand shock could be unlike anything we've seen in financial markets. And here's where the mathematics gets uncomfortably compelling. Bitcoin's supply is permanently fixed at 21 million coins. A significant portion of those coins haven't moved in years and may never move again. So when Wood talks about trillions of new dollars competing for access to a genuinely scarce asset, she isn't talking about hype. She is talking about supply and demand at a scale that makes normal market dynamics look quaint. Prices don't adjust gradually under those conditions. They reprice violently. Now here's the question I want you to answer honestly, either in the comments or just to yourself. If institutional adoption is still this early, why does it feel like Bitcoin has already had its moment? What does that feeling tell you about the gap between perception and reality in financial markets? Stay with me, because the next chapter is where we start looking at the actual mechanics behind all of this, and where the story gets much more specific. But here's what they're not telling you, and this is the part most financial channels never get to. The biggest bullish case for Bitcoin in 2026 has almost nothing to do with crypto culture or ideology. It has to do with plumbing, infrastructure, the actual mechanics of how money flows, and that's what we're digging into next. Tom Lee is one of the most analytically rigorous voices on Wall Street. And unlike some Bitcoin commentators who lead with ideology, Lee leads with data. His focus is market mechanics, supply, demand, flows, and what happens when those three variables move in the same direction simultaneously. Here's the reality as it stands today. Every 4 years, the Bitcoin network goes through a halving, a programmatic reduction in the rate at which new Bitcoin is created. We went through one in 2024. The effect isn't instantaneous. It plays out over months and sometimes years as the reduced supply of new coins slowly tightens the market. At the same time, institutional access to Bitcoin has never been easier in the asset's entire history. Bitcoin spot ETFs, which were approved in the United States at the start of 2024, have fundamentally changed the game. They have given pension managers, registered investment advisors, wealth management platforms, and family offices a way to gain Bitcoin exposure without touching a crypto exchange, without managing a wallet, without worrying about seed phrases or custody. The result is a fascinating structural imbalance that Lee has been highlighting for months. Access is expanding, supply is contracting, and these two forces are moving toward each other like tectonic plates. I want you to think about a very simple analogy. Imagine a stadium with a fixed number of seats. Now imagine the doors of that stadium are open to millions of new attendees who have never been able to get in before. The seats don't multiply, the building doesn't expand, but suddenly everyone wants in. That's the Bitcoin market right now, and if Tom Lee's read on the flows is correct, if institutional demand continues accelerating into a supply-constrained market, the moves that are coming could make the current $61,000 price look like an historical footnote. Hit like if this supply and demand dynamic is something you think more people need to understand. Because I genuinely believe this is one of the most underappreciated stories in finance right now. Now, here is where I'm going to deliberately slow down. Because I think the most important voice in this entire conversation is the one that doesn't fit neatly into the bull narrative, Peter Brandt. If you don't know Brandt, understand this. He is one of the most respected technical traders alive. He has been reading markets for longer than many of his followers have been alive, and he has no financial incentive to be bullish or bearish on Bitcoin. He simply follows what the patterns are telling him. And right now, his message is not a comfort. Brandt's warning is not that Bitcoin is going to zero. He is not a Bitcoin denier. His warning is far more nuanced, and honestly, far more useful for anyone who is actually trying to build wealth rather than just feel good about their portfolio. His point is this: Bitcoin can absolutely be a long-term winner. The destination could be everything the bulls are promising. And Bitcoin can still inflict genuine, devastating pain on investors along the way. Most retail investors have a fundamental misunderstanding baked into their thinking. They hear bullish long-term, and their brain automatically translates that into up from here. But that is not how the strongest bull markets in history have worked. The most powerful long-term bull markets, in stocks, in real estate, and gold, have contained corrections so violent that they convinced millions of people the story was permanently over. Think about the investors who bought Bitcoin at $69,000 in November 2021. The asset they owned eventually recovered and moved higher. But first, it dropped all the way to $15,500. That is a drop of nearly 78%, from peak to trough, on an asset that ultimately recovered. How many people survived that psychologically? How many sold at $20,000, certain the experiment was over? How many institutional mandates would have been violated? How many margin calls would have been triggered? Brandt's message isn't pessimism, it's preparation. Because the path to Bitcoin's potential destination may be far uglier than any of the bull case presentations ever show you. So here's the question that I think every single person watching this needs to genuinely answer for themselves. If Bitcoin dropped 50% from here to around $30,000, what would you actually do? Not what you think you should do. What would you actually do? Comment your honest answer below. Because I think your answer to that question is worth more than any price prediction from any analyst. You need to understand this before I show you what's next, because the next chapter is the one that ties everything together. And it's the variable that almost every retail investor completely ignores when they're building their Bitcoin thesis. Here is something I've learned about financial markets over years of studying them. Money moves before narratives do. Headlines follow flows. And if you want to understand where Bitcoin is actually going, one of the most important things you can do is ignore what institutions are saying and watch what they are doing. And what they are doing right now is structurally significant. The Bitcoin spot ETF market has not just created a new investment product. It has created a new class of Bitcoin buyer, one that operates completely outside the traditional crypto ecosystem. These buyers don't use exchanges. They don't have wallets. They don't follow crypto Twitter. They don't participate in the community discussions that have historically shaped Bitcoin's price narrative. They simply allocate capital through a ticker symbol, the same way they would buy an S&P 500 fund or a gold ETF. This matters in a way that is genuinely hard to overstate. For most of Bitcoin's history, its price was determined almost exclusively by people who had made a deliberate choice to engage with crypto. Believers, speculators, traders, and technologists. It was a closed ecosystem with its own culture, its own language, and its own volatility patterns. That era is ending. Bitcoin is now accessible to capital pools that have never had a Bitcoin opinion in their lives. Pension funds that manage retirement assets for millions of teachers and firefighters. Endowments that fund universities and hospitals. Registered investment advisors who manage wealth for families who have never thought about blockchain technology for even a single moment. And here is what this transition means for the market. When capital flows from these institutional players, it doesn't come in speculative bursts. It comes in systematic allocations, quarterly rebalancing decisions, strategic asset allocation shifts, multi-year investment mandates. It is slow, steady, and enormous. Bitcoin has crossed a threshold. It no longer needs crypto true believers to move. It can now attract the most conservative capital on earth. And that is an entirely different game than anything we've seen before. By the way, what are you doing while watching this video? Drop it in the comments. I'm always genuinely curious what kind of multitasking my audience is capable of. Here's the conversation that very few people in the Bitcoin space want to have openly, because it complicates the clean ideological narrative. Liquidity, not supply and demand within the Bitcoin market. Global liquidity, the total volume of money flowing through the broader financial system. This is the hidden variable that connects almost every Bitcoin cycle to the macroeconomic environment. And if you want to understand why Bitcoin is consolidating around $61,000 in June 2026, despite all of the bullish structural arguments we've walked through today, this is the explanation. When global liquidity expands, when central banks are cutting rates, when credit is cheap, when money is actively being pushed into the financial system, risk assets tend to thrive across the board. Stocks go up, real estate goes up, commodities go up, and Bitcoin, which is one of the most sensitive barometers of risk appetite on Earth, goes up significantly faster than almost anything else. When liquidity tightens, when central banks are holding rates elevated, when credit conditions are restrictive, when institutional investors are de-risking, even genuinely great assets can struggle. And Bitcoin, given its volatility profile, can struggle more violently than anything. Right now, we are in a tightening environment. The PCE inflation data releasing today, the Federal Reserve's preferred inflation gauge, is expected to show inflation at 3.8% year over year. That number matters enormously, because if inflation remains sticky, the Fed's ability to cut rates and re-inject liquidity into the system gets pushed further out on the calendar. And that means Bitcoin investors are watching central bank decisions with an intensity that would have seemed strange just 5 years ago. Not because Bitcoin has somehow become a Fed-dependent asset, but because all liquid markets are connected by the same underlying monetary plumbing. This is where it gets really concerning for people who expected Bitcoin to be immune from macroeconomic forces. It has never been fully immune. And in the current environment, the timeline for Bitcoin's next major leg up may hinge less on crypto-specific developments and more on when global monetary conditions begin to shift. The bullish thesis remains intact. The structural arguments from Saylor, Wood, and Lee remain compelling. But the timing, the when, is being controlled by forces that no Bitcoin developer or crypto advocate has any power over. And that is the uncomfortable truth at the center of every serious Bitcoin conversation happening in private right now. So let's bring all of this together, because I want to leave you with something more useful than a price prediction. Michael Saylor sees digital property, the hardest monetary asset in human history, slowly absorbing value from every other store of wealth on Earth. Cathie Wood sees an adoption curve that is still in its early innings, with institutional capital barely having touched the surface of what's possible. Tom Lee sees a supply shock playing out in slow motion, with access expanding into a market where supply cannot. Peter Brandt sees a destination that may be higher than anyone expects, but a path that may be far more brutal than anyone is prepared for. And Wall Street, quietly and systematically, is repositioning in ways that are structurally different from anything that came before. And underneath all of it, the Federal Reserve may still hold more influence over the timing of Bitcoin's next major move than any of these investors would like to admit. But here's the takeaway I want to leave you with, the one that I think matters most regardless of where Bitcoin goes next. None of these people, not one, is debating whether Bitcoin is real. None are debating whether it matters. None are questioning whether it deserves a place in a serious conversation about the future of finance. That argument has been settled. The debate that remains is far bigger and far more interesting. How large does Bitcoin ultimately become? How quickly does the adoption curve accelerate? And critically, who positions themselves thoughtfully before the rest of the world figures it out? Because the future of Bitcoin may not be decided by retail traders refreshing price charts at 2 a.m. It may not even be decided by the crypto community that built this thing from nothing. It may ultimately be decided by the largest, most patient, most systematic pools of capital on Earth. And if that is true, if that is where this is genuinely heading, then what we are watching today in June 2026 may not be the peak of Bitcoin's story. It may be the quiet, unglamorous, uncomfortable middle of the most important monetary transition in modern history. Share this video with someone in your life who is trying to make sense of what's happening in markets right now. Not to convince them of anything, just to give them a more complete picture than they're getting from the mainstream financial media. Subscribe to the Wealth Continuum if you want to keep having these kinds of conversations. The ones that go deeper than the surface, that take the long view, and that treat you like an intelligent adult who can handle complexity. That's exactly what this channel is built for. And drop your biggest question from today's video in the comments. What was the moment that made you stop and think? What did you disagree with? What do you want us to dig into next? I'll see you in the next one. This is the Wealth Continuum, and we're just getting started.